Hey, it's Darius. Here's an opportunity to join my I-75 CMA Facebook group. It's brand new, so you could be one of the early influencers. I'll leave a link in the description. The exam expects you to know the internal controls in the revenue cycle. You're likely to be tested on the documents, the departments, the control activities, and some of the technologies. And unless you've worked in a warehouse, you're probably not familiar with these departments, these documents, these control activities, and yet they'll be on your exam. So by the time we finish this video, you'll know what the sales department does, what the credit department's responsible for, the shipping department, the warehouse, and the billings department. And this is considered to be a fairly sophisticated topic. The purpose of the revenue cycle is to sell items and collect payments on receivables. But how do they do it? Well, the major activities of the revenue cycle include sales orders coming in, customers' credit needs to be checked, you need to have physical or virtual custody of the product, you need to be able to release the product to the customer, maybe ship the goods if it's tangible, billing customers, manage receivables, manage returns and allowances, determine collectability of accounts, collect payment, checks come in, they got to be deposited. And doesn't there have to be a bank reconciliation at some point by someone other than the bookkeeper? So in the sales department, the customer order comes in. The order should be forwarded to the credit department, which will approve or deny the customer credit. And most business-to-business transactions don't involve a credit card. They involve trade credit, 30 days of credit. So your customer is allowed to pay within 30 days, and you might even give your customer 2% off if they pay within 10 days. But you only want to extend that offer to a customer with good credit. So you need a credit department to approve or deny customer credit. Then, assuming the credit's good, the warehouse will fill the order and then send the goods to the shipping department, who will then ship the goods to the customer. So one of the core activities is there has to be a department or two that has physical custody of products or services. And the warehouse has physical custody, but the warehouse shouldn't be the one who sends the goods to the customer. The warehouse should only be able to send the goods within the company. It's the shipping department that gets to send the goods to the customer. And then you have accounting or accounts receivable department, whose job it is to invoice the customer for that sale on credit after shipping. Because if you don't send an invoice to the customer, the company's never going to get paid. Because remember, we gave the customer 30 days to pay. So who's going to handle that money when it comes in? We call it a cash activity, but the collection of payment is probably going to be by check. But it needs to be deposited, and ultimately a bank reconciliation needs to be prepared. Which of the following is not a core activity of the revenue cycle? A, payments to vendors. B, physical custody of products and services. C, receiving customer orders and approving or denying credit. D, billing the customer for the sale after shipping. Letter A is the correct answer. Paying vendors would not be part of revenue because revenue involves selling and collecting. Instead, paying vendors is part of the expenditure cycle. But this video is all about the revenue cycle, so let's look at the forms, the files, the documents in the revenue cycle. And this is where the exam questions are likely to come from. So here's the sequence of documents in the revenue cycle. The customer or the sales order comes in, and that's purpose is to document the sale. It should include the item, the price, the stock number. Then that sales order should go right to the credit file to document granting or denial of credit by the credit manager. And the credit manager, you need to know, should be independent of the sales department. Why do we want the credit manager to be independent of sales? Because the salespeople only care about their commission. They want to just push out the product, drive sales, earn a lot of commissions. They don't care whether the company ultimately ever gets paid or not. They'll worry about that later. They'll let somebody else worry about that. So the credit manager needs to be objective. And if the credit manager had to report, let's say, to the VP of sales, then the credit manager would not be able to be objective enough. And if the credit manager wasn't objective, then everybody would be getting credit. The company would have a lot of sales, a lot of receivables, but never get paid. So the credit manager should report to somebody in the company other than the VP of sales. A good person for the credit manager to report to would be the treasurer, who handles the cash after the sale has been completed and the customer has paid. That would be a good person for the credit manager to report to, but not to the VP of sales. Then we have a receivables aging schedule, which lists the receivables by date, how old they are, and gives evidence of collectability. Obviously, the older the receivable in the aging schedule, the less likely it is to be collected. Receivables from sales that are less than 30 days old are much more likely to be collected than receivables on the schedule that are from 6 months ago, a year ago, or more. And this ties into what we said about the credit manager needing to be independent of the sales department. Because if the credit manager could be bullied by the VP of sales, you'd end up with a lot of old receivables on the receivable aging schedule, and those receivables will have to be written off. And that's not good for the company long term. Other forms, documents, or files in the revenue cycle, a picking list. So what happens is when an order comes in, if it's approved, it shows the items that need to be picked from the warehouse, usually using barcode or what's called RFID tagging, which is technology that transmits data from the tag to the computer, the AIS. And that's how the company knows that it might be time to reorder because these items keep getting sold. So who prepares the picking list? It's created automatically in what's called a warehouse management system. Once credit is approved, a picking list is created. That picking list goes to the warehouse, and using barcode or RFID tagging, the people in the warehouse will use that picking list to select the items for the order. Keep in mind that the warehouse should not pick any goods out of the warehouse until they receive an approved sales order from the credit department. If there's a warehouse management system, then it'll be automatic. As soon as credit is approved, the warehouse will get a picking list and they can go ahead and pick goods. If it's a manual system, there won't be a picking list automatically generated, but goods will still need to be selected from the warehouse. If it's a manual system and there's no automatically generated picking list, then the warehouse people need to wait until they get an approved sales order from the credit department. And then the warehouse can go in and start picking the items. But no items should be sent to the shipping department from the warehouse until warehouse gets an approved sales order or a picking list. What's a packing list? Well, that indicates the contents to be shipped. The packing list is prepared by the shipping department and matched with the picking list at the shipping department just prior to shipping. And then someone from the shipping department has to sign the packing list and take responsibility for matching that what was supposed to be shipped, the items on the picking list, are actually being shipped. All right, then what's a bill of lading? A bill of lading is a legal document that helps determine when revenue can be recognized for the entity. Because if the item is shipped, let's say, by the last day of the quarter, then they can recognize revenue on the last day of the quarter, even though the goods haven't arrived yet. The items are still in transit, but the bill of lading says FOB shipping point or FOB destination, and if it's FOB shipping point, then revenue can be recognized at the point of shipment. Whereas if it's FOB destination, you might have to wait until the goods arrive. You might have to know that it's the bill of lading that determines who has title and risk of loss during transit. So the bill of lading helps to determine when revenue can be recognized and who has title and risk of loss during transit. Let's review that. Who has title and risk of loss while the goods are in transit? Well, whatever's after the FOB fixes the seller's last point of responsibility. So if the shipping terms are FOB destination, then the seller is responsible all the way until the goods reach their destination. Title and risk of loss would remain with the seller if it's FOB destination. While the goods are in transit, the seller's responsible. But if it's FOB shipping point, the seller's responsible only until the goods are delivered to the carrier. Title and risk of loss pass to the buyer when carrier takes the goods off the seller's loading dock. So there's only two situations, either FOB destination or FOB shipping point, and whatever's after the FOB fixes the seller's last point of responsibility. Let's try this. Under FOB shipping point terms, at what point does the buyer take ownership of the goods? A, when the goods are shipped. B, when the goods are in transit. C, when the goods arrive at the buyer's location. Or D, when the buyer pays for the goods. And the answer is A, when the goods are shipped, because under FOB shipping point terms, the buyer takes ownership of the goods as soon as they leave the seller's loading dock. This means that the buyer assumes the risk and responsibility for the goods during transit as the owner of the goods. And the question asked under FOB shipping point, at what point does the buyer take ownership? And the answer is when the goods are shipped. The other important thing about the bill of lading is that it lets the company know that now the goods have been shipped. It's okay to send a customer invoice so that we can get paid. And just before this customer invoice is prepared, someone has to match the bill of lading with the approved sales order to make sure that if 100 cases of Snapple iced tea were ordered, that 100 cases of Snapple iced tea were actually shipped out. And that's the billings department's job, an accounting function. The billings department is an accounting department. First, they match the bill of lading with the approved sales order, and if those two documents agree, they prepare the customer invoice and they send that invoice to the customer, also called a sales invoice. And then there's remittance advice. So now that the customer has gotten the bill, they're going to make a payment one of these days, and they'll send a payment with a pre-enclosed turnaround document that we've given them to indicate how much they're paying towards the balance owed. That's called remittance advice. And then every month there should be customer statements mailed to customers for accuracy and for existence of receivable. Accuracy, so the customer could say, hey, how come you're billing me all this? I paid last week. Okay, well, it must have crossed in the mail. Also, with regard to accuracy, we mail these customers a monthly statement to make sure that we as a company posted the receivable to the right customer. Because if we posted it to the wrong customer, by sending out the customer statements every month, we'll probably get a response from that customer who doesn't owe that amount. Existence, very important. We send out these customer statements monthly so that if any customer gets a statement and says, hey, how come you're billing me? I haven't ordered from you in 2 years. Then we know there's an error somewhere, possibly fraud, but at least there's an error somewhere because a customer is getting a statement for something that they never ordered. Possibly that's an accuracy issue where we posted it to the wrong customer, or it could be a fraud issue where no sale was ever made and a false transaction was entered. Something else I want to point out, note that the bill of lading is not prepared by billing, even though it's got the word bill in it. Bill of lading, not prepared by billing. Who prepares the bill of lading? Shipping. Billing prepares the sales invoice after the goods are shipped out. Here's a couple of questions. To minimize the risk associated with goods being released from the warehouse for unauthorized use, approved sales invoices should be required for goods to be released from the warehouse. And the answer is false. You would want to have an approved sales order at the warehouse before goods are released from the warehouse to the shipping department. An approved sales order, not a sales invoice, because a sales invoice is prepared after goods go to the shipping department and goods are shipped out to the customer. So watch out for the wording. A sales order is not the same as a sales invoice. The sales order is the first document prepared in the revenue cycle, where the sales invoice, the customer invoice, that's not prepared until the bill of lading is matched with the approved sales order, and that's not done until goods are shipped out. So let's look at this question again. To minimize the risk associated with goods being released from the warehouse for unauthorized use, approved sales invoices should be required for goods to be released from the warehouse? No. Approved sales orders should be required for goods to be released from the warehouse. Or what else? You could have a picking slip automatically generated from the warehouse management system. Once the credit is approved, there'll be a picking slip automatically generated for the warehouse, and then they can go ahead and grab those items out of the warehouse and send them to shipping. Question 2, to minimize the risk of sales invoices being posted to incorrect customer accounts, monthly statements should be mailed to all customers with outstanding balances. Absolutely. This is true. If monthly statements are mailed to all customers with outstanding balances, a customer who should not have an outstanding balance would notice the error and likely report it right away. Thus, the company should not only mail these statements, but also analyze customer responses. Customer credit should be approved or denied by A, the sales department prior to the goods being shipped. No, the sales department should not be approving or denying credit. The credit department, B, prior to the warehouse sending the goods to shipping, yes. The credit department should be the one who's approving or denying credit. There's a credit manager, and that's the credit manager's job. Not accounts receivable after the warehouse already sends goods to shipping too late, and not the shipping department after the goods are picked from the warehouse. So we'll go with B, customer credit should be approved or denied by the credit department prior to the warehouse sending any goods to shipping. The billing department prepares which of the following documents in the revenue cycle? Is it A, the bill of lading? No, the bill of lading is not prepared by billing. It's prepared by the shipping department. B, the sales order? No, that's prepared in the sales department. C, the sales invoice? Yes, that's what the billing department prepares, the sales invoice or the customer invoice, not the picking and packing slip. So letter C is correct. The billing department prepares the sales invoice after reconciling the approved sales order received from the credit department to the bill of lading received from the shipping department. If both documents match, if 100 cases of Snapple were ordered and approved and 100 cases of Snapple were shipped out, that's when the billings department, who's an accounting department, prepares the sales invoice and sends it to the customer. In a warehouse management system, what form is used in the warehouse to assemble the goods for customers' orders to be sent to the shipping department? Is that a packing ticket or packing slip? No. A picking ticket or picking slip? Yes. Not a sales invoice, not a bill of lading. Letter B is correct. In a warehouse management system, when customer credit is approved, a picking ticket is automatically issued for the warehouse to go ahead and pick the items ordered by the customer and bring those items to the shipping department. A is wrong because a packing ticket is made up by the shipping department. C is wrong. The sales invoice is prepared by the billings department, and the bill of lading is a shipping document prepared by the shipping department. Letter B, a picking ticket would be generated before any of these other documents or forms. You'll see the term form used instead of document if it's a computer-generated system. If it's a computerized system, you'll see the term form or even the term screen. So form or screen, that relates to a computerized system. The term document, that relates to a manual system. Which of the following is a legal document that defines responsibility for goods in transit? It's not a picking or packing ticket. Wouldn't be the sales invoice. But letter D, the bill of lading, is a legal document that helps determine who has responsibility for goods while in transit and also determines when revenue can be recognized. Which of the following is prepared by the shipping department is an internal document rather than a legal document that lists the contents to be shipped? Is it a picking slip or picking ticket? No. Is it a packing slip or packing ticket? Yes. Sales invoice, sales order? No. B is the correct answer. A packing slip or packing ticket is an internal document, not a legal document. It stays within the company. It lists the contents to be shipped. Its purpose is to prepare it and then compare it to the picking ticket and make sure that before goods are shipped, that what was picked from the warehouse is now ready to be shipped. Which of the following files, forms, or documents could indicate that a company may need to tighten up its policy of extending credit to customers? Would it be the sales invoice, A? No, the sales invoice won't indicate that the company's too loose with its credit. The bill of lading? No. The receivable aging schedule? Yes. A receivable aging schedule shows each receivable by age. If the company has many receivables on the schedule that are more than 6 months past due, this could indicate that the company is extending credit to customers without first checking the customer's credit history. Even a mediocre auditor could look at an accounts receivable aging schedule and see that a company is too loose with its credit policy. If they have a lot of old receivables, it means the company should be doing a better job of checking credit history before shipping goods to customers. How about this? RFID tagging is most helpful to business processes related to what? Think you know? Leave me the answer in the comments section. And if you're struggling with the CMA exam or the CPA exam and you found this video helpful and want to see the rest of it and more videos like it, get yourself on I-75 with me, Darius Clark. I'll leave a link in the description. You see the menu bar at the top. If you're a CMA candidate, you click here and choose Part 1 or Part 2. I-75 CMA is the only material that you will need to pass the exam. You might have some other stuff, but you don't need it. In fact, if you don't think I-75 is better than any other CMA material that you have, let me know, and I'll let you return it for a 50% refund. So what do you have to lose? So whether it's CMA or CPA, go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.